So one of the most common questions I get, you've probably even asked it yourself before if you own a business, is what about Social Security? And this means all sorts of things to all sorts of different people. But one of the most common ones from my business owner clients, and unfortunately I only get it around the time they're getting ready to retire and start claiming, is how can I make sure I get the most out of Social Security? But really the time to plan for that is before the year you hope to claim Social Security. In today's video, we're going to talk about a few things you can do to help make sure you get the most out of Social Security as a business owner. Hi, I'm John Norbert, and welcome to the Financial Prof series. So Social Security as a business owner, what do you do not only in the beginning, but also as your career continues to progress to make sure that you are getting the most out of it when the time comes to take some of that money back that you've paid in over all those decades? Well, I'm going to give you 3 quick hit tips that hopefully you can implement in your business to help make sure that you do. So, tip number 1, make sure you pay yourself enough. What does that mean? Well, for instance, this year, Social Security gives us the number $168,600. What does that mean? Well, it's the number of dollars that you can earn that are going to count towards Social Security. So by paying yourself at least that amount in your business, it can make sure that when it comes time to claim Social Security, you are going to get the legal max, potentially, because that number does go up year over year, that you can from Social Security. So if you earn more than that in taxable income, earned income, you're not going to get anything more out of Social Security, even if you're taxed on it. So if you earn $1 million versus 168.6, it's not going to matter. You're going to get the same Social Security no matter what. Now, as you probably already know, Social Security only counts the highest 35 years of earnings, so that's a good thing for most of us because it means those car wash jobs, those dishwasher jobs, those bartending jobs that we all had when we were in our teens and maybe early 20s aren't going to count against us because of those low wages. So that's a plus, but when you are deciding how much is earnings and how much is owner's distribution in your business, it's a really good idea to make sure that Social Security does enter into that equation, because what I can see sometimes is some business owners who come across my desk and they're paying themselves $30,000, maybe $40,000 in income. And there can be reasons for that. But the first question is that a reasonable income according to what the IRS might think? And of course, the other question that goes along with that is, are we comfortable with the trade-off that when it does come time for us to claim Social Security and get some of those dollars back that we paid in over the years, are we comfortable with the fact that we're only going to get the dollars that would count as if we'd earned $30,000, $40,000 for our whole careers? So maybe it makes sense, especially in light of things like the qualified business income deduction, the QBI deduction that we talked about last time, or one of our most recent videos, to maybe think about, should it bump up? Should our earned income, our W-2 wages, in other words, in our business, be bumped up so that we maybe get a little bit better of a Social Security payout, among other reasons? Okay, tip number 2. If you have a spouse, make sure you're paying them enough. So a lot of business owners have a spouse who works for them in the business, and sometimes they get a paycheck, and sometimes the first spouse who's doing the business owning and running gets the only paycheck. There can be reasons for that, but the drawback of such an approach is that if you do it that way, and then years down the road you get to the Social Security claiming table, and let's say that for whatever reason that spouse who was working in the business but wasn't the primary business owner role decides to retire, quote unquote, and claim Social Security, maybe claim early. 62 is the earliest that we can claim right now. If they do that and they don't have Social Security tax withheld from their wages because they never had any wages at all, or if they did, it wasn't withheld properly, then the Social Security Administration is going to say, tough luck. You don't have any qualifying credits. Or if you do, it's maybe from a few years of working those dishwasher jobs, those table serving jobs in high school, or whatever the case may be. Good news, if this is you, and you're the only one being paid through the business, and you want your spouse to be able to retire and claim early, there can still be some ways to fix this so that the right Social Security is claimed, but it's going to take a lot of headache and possibly some unexpected expense to be able to fix it. So I highly recommend that when you do pay yourself through your business, if you have a spouse working for you, that spouse is paid according to what they're actually doing. All right, so then tip number 3. This has to do with timing. So make sure you get the timing right. What does that mean? Well, remember that Social Security is, when you turn it on, going to be income that potentially lasts for your lifetime, right? And so a lot of the time what I see is that a client will, in fact, I just had this a few weeks ago. I'll give you an example. A client came into my office with their spouse and said, we're thinking about turning on her Social Security, the spouse's, next year. But the other part of the conversation that we had just finished having was, well, I'm also thinking about selling a significant piece of my real estate empire. And this is going to come with a lot of capital gains, as we discussed, not to mention depreciation recapture. So the bottom line was that next tax year was going to be a very high tax year for them as they recapture that depreciation and recognize those capital gains. And if we turned on that Social Security next year, obviously that's just going to get added on top of everything else that they're already going to be recognizing in the taxable realm. So for them, we decided, we're just going to continue to recognize the income from the rentals that we have and allow that sale of this piece of the rental empire, if you will, to give us the rest of the income that we need for the year. And then the following year, after that large sale, claim Social Security. And this is something that tends to get overlooked a lot, that may or may not significantly affect your taxable scenario, because remember, depreciation recapture is considered part of ordinary income. So if you add that together with the Social Security that you just started claiming, plus potentially a large capital gain, you could be looking at bumping up 1, 2, 3 multiple tax brackets. So if you found this information useful, we'd love it if you drop us a like, a subscribe, and in the meantime, we'll see you out there.